Listen, I'm about to tell you something that's going to sound completely backwards in today's world of instant gratification and split-second decisions. The traders making the most consistent money aren't the ones glued to their screens watching every tick, aren't the ones making dozens of trades per day, and definitely aren't the ones bragging about their quick wins on social media. The real wealth is being built by people who sometimes make just a handful of trades per year. Sounds crazy, right? But by the end of this, you'll understand exactly why patience isn't just a virtue in trading. It's literally the difference between building wealth and watching it evaporate. Here's what nobody tells you when you first get interested in trading. The entire industry is designed to make you think speed equals success. Every advertisement, every trading platform, every influencer shows you these rapid-fire trades, flashing screens, and the promise of quick money. They sell you on the excitement, the adrenaline, the idea that you can outsmart the market by being faster than everyone else. And you know what? That's exactly how they make their money, because every time you trade, someone is collecting a fee. Let me share something with you that changed everything for me when I learned it. Warren Buffett, one of the wealthiest investors on the planet, has held some of his best positions for decades. Not days, not weeks, decades. His holding period for Coca-Cola started in the late 1980s. Think about that for a second. While day traders were making thousands of trades, Buffett made one decision and let it compound for over 30 years. The result? Billions in returns from a single patient decision. But this isn't just about one legendary investor. There's actual hard science behind why slow trading beats fast trading, and it starts with something called transaction costs. Every single time you make a trade, you're paying. You're paying broker fees, you're paying the spread between the bid and ask price. And if you're trading frequently enough, you're paying significantly higher taxes on short-term capital gains. These costs seem tiny in isolation. A few dollars here, a small percentage there, but they compound in the wrong direction. Studies have shown that the average day trader, someone making multiple trades per day, can lose between 2 to 4% of their account value annually just to transaction costs alone. Now imagine you're making 200 trades per year instead of 2. You've just eliminated 99% of those costs. That money stays in your account, working for you instead of disappearing into fees. Then there's the psychological component, and this is where things get really interesting. Our brains are not wired for good trading decisions. Evolution designed us to react quickly to immediate threats. See a lion, run; touch fire, pull back. This instant reaction system kept our ancestors alive, but it's absolutely terrible for making investment decisions. When you're watching charts all day, your brain interprets every downtick as a threat and every uptick as an opportunity. You become emotionally reactive instead of strategically thoughtful. Fast traders fall into what psychologists call the action bias. This is our tendency to favor action over inaction, even when doing nothing would produce better results. In trading, this manifests as the overwhelming urge to do something, anything, when you see your portfolio moving. The market drops 2%, and your hands are itching to sell. It rallies 3%, and you're desperate to buy more. But here's the brutal truth. Most of those moves are just noise, meaningless fluctuations that have zero bearing on long-term value. A fascinating study looked at the trading records of thousands of individual investors over several years. The researchers found something remarkable. The investors who traded the most frequently had the lowest returns. Meanwhile, the investors who traded the least, who basically bought and held, significantly outperformed. One group that did exceptionally well, people who had forgotten they even had investment accounts. They weren't geniuses. They weren't employing sophisticated strategies. They simply weren't interfering with their own success. Let's talk about something called reversion to the mean. Markets fluctuate constantly. A stock might drop 15% on earnings news, but if the underlying business is solid, it typically recovers. The fast trader sees that 15% drop and panics, selling at the bottom. The slow trader understands that short-term price movements don't reflect long-term value. They either hold through the volatility, or, if they have conviction, they buy more at the discount. 6 months later, when the stock has recovered and pushed higher, the slow trader has made money while the fast trader locked in a loss. This principle applies across all market conditions. During the financial crisis of 2008, traders who sold in panic locked in massive losses. Many never recovered because they sold low and then were too scared to buy back in. Meanwhile, investors who held through the crisis, or better yet bought during the panic, saw their portfolios not just recover but reach new heights in the following decade. The difference wasn't access to better information or superior trading technology. It was temperament and time horizon. Now here's something the fast trading crowd really doesn't want you to know. The vast majority of day traders lose money. Not some of them, not half of them. Studies show that roughly 90% of day traders quit within their first year, and most do so at a loss. Of the 10% who continue, only a tiny fraction are consistently profitable. These aren't just random statistics. These are the results of academic research examining actual trading records from millions of trades. Why such dismal results? Because day trading is fundamentally a negative-sum game after costs. For every winner, there's a loser, and everyone is paying fees. When you're competing against high-frequency trading algorithms that can execute thousands of trades per second, sophisticated hedge funds with teams of analysts, and market makers with better information and lower costs, your odds of consistently winning as a fast retail trader are incredibly slim. Compare that to slow trading, to investing. When you buy quality assets and hold them long-term, you're not trying to outsmart other traders. You're becoming a partial owner of productive businesses that generate value over time. As long as these companies keep making money, innovating, and growing, your investment grows with them. You're not playing a zero-sum game anymore. You're participating in wealth creation. Let me give you a concrete example. Imagine two traders both starting with $50,000. Trader A is fast, making 2 trades per week, trying to catch short-term moves. Assuming they're actually skilled, which most aren't, and they make an average of 1% per trade before costs. Sounds good, right? But after trading fees and short-term capital gains taxes, which can be as high as 37% in the United States, their real returns are significantly reduced. Factor in the inevitable losses that come with frequent trading, and their account might grow modestly if they're lucky, or more likely, shrink. Trader B is slow. They spend weeks researching quality companies, make 6 carefully considered investments throughout the year, and hold for multiple years. Their returns come from business growth and dividends. They pay long-term capital gains taxes, which are much lower, sometimes just 15 or 20%. Over a decade, with both traders showing skill in their approach, Trader B will almost certainly have significantly more wealth. Not because they were smarter or worked harder, but because they understood that time in the market beats timing the market. There's also the stress factor that nobody talks about enough. Fast trading is exhausting. You're constantly monitoring positions, reading news, analyzing charts, making decisions under pressure. It consumes your day and invades your mental space even when you're not actively trading. The emotional toll of watching your account value fluctuate by thousands of dollars daily can be devastating. Studies have shown that frequent traders experience higher levels of stress, anxiety, and even depression compared to long-term investors. Slow traders sleep better, literally. When you're invested for years rather than hours, daily market movements become background noise. You check in periodically, rebalance occasionally, but you're not enslaved to the market's every move. This peace of mind has real value, both for your mental health and for your decision-making quality. Stress impairs judgment. Calm, patient thinking leads to better outcomes. Here's another critical factor: tax efficiency. In most countries, short-term capital gains are taxed at significantly higher rates than long-term gains. In the United States, if you hold an investment for less than a year, your profits are taxed as ordinary income. Hold it for more than a year, and you qualify for long-term capital gains treatment, which could mean paying less than half the tax rate. This difference compounds dramatically over time. The money you save on taxes stays invested, growing and compounding for you. Let's address the argument that fast traders make about capturing more opportunities. Yes, theoretically, if you make more trades, you have more chances to profit. But this logic ignores base rates and probabilities. If your win rate on individual trades is 55%, which would be considered quite good, and you make 100 trades, you're going to lose on 45 of them. Each loss chips away at your capital. Meanwhile, if you make 5 highly researched trades with an 80% success rate based on fundamental value investing, you're only wrong once. Fewer opportunities but better quality equals better results. The greatest investors in history all share one common trait: patience. Peter Lynch, who managed the Fidelity Magellan Fund to incredible returns, held stocks for years. His famous advice was to know what you own and why you own it. Charlie Munger, Buffett's partner, talked constantly about the importance of sitting on your hands, of doing nothing as a strategy. John Bogle, who founded Vanguard and revolutionized investing, advocated for buying index funds and never selling them. These aren't people who got lucky. They're people who understood that wealth compounds over time, not overnight. Think about compound interest for a moment. Einstein allegedly called it the eighth wonder of the world. When you're a slow trader, you let compound interest work its magic. Your returns generate returns. Your dividends buy more shares that generate more dividends. This snowball effect requires time to build momentum. Fast traders constantly interrupt this process. They sell, pay taxes, pay fees, and have to start the compounding process over with a smaller base each time. There's also information asymmetry to consider. Fast traders believe they can profit from short-term information advantages. But in reality, by the time retail traders see news, institutional traders with better tools and direct market access have already acted on it. The price has already moved. You're not getting a deal. You're reacting to something that's already priced in. Slow traders sidestep this entirely. They focus on information that doesn't change by the minute. Business quality, competitive advantages, management competence, long-term trends. This information is available to everyone and doesn't require split-second reactions. Here's something practical you can implement immediately. Track your trades for 6 months. For every fast trade you make, trying to catch a quick move, write down your reasoning, entry price, exit price, and the result after all fees and taxes. Be honest about your actual returns. Most people who do this exercise are shocked to discover they would have been better off doing nothing. The data doesn't lie. Your gut feeling about being a successful fast trader often contradicts what your account history actually shows. The path to trading success isn't found in speed, complexity, or activity. It's found in patience, selectivity, and discipline. It's found in understanding that building wealth is a marathon, not a sprint. The market rewards those who can think in years and decades, not minutes and hours. Every legendary investor, every verified success story in the investment world points to the same conclusion. Slow and steady wins the race. So the next time you feel that urge to make a quick trade, to react to market noise, to do something because you're bored or anxious, remember this. The best trade might be no trade at all. Your future wealthy self will thank you for the restraint you showed today.